Well, hello, good morning. You're watching NDTV Profit. Thanks for tuning in. I'm Harsh Saita. We have with us the management of KFintech Technologies. It's a unique company from a perspective that it's more of a service provider to the financial services industry as a whole, and it ought to be buzzing because the financial services industry as well as some of the SIP numbers have been extremely strong. But to talk about that and more, let me bring on board Mr. Sreekanth Nadella, who's the MD CEO at KFintech. First off, welcome, good morning. Mr. Nadella, talk to us about the quarter gone by, Q1. It's been strong growth, or another quarter of strong growth, 30+%, 4% sequential. On the top line. How is FY25 expected to be for you? And just talk to us about how trends are playing out.
Good morning, and thanks for having me over. Indeed, it was a good quarter, as had been the case for the past 5 to 6 years, pretty much with the capital markets buzzing around, in India, and in the spaces that we are in, more specifically, we are in fact, only intermediary, who operates on both ends of the spectrum, which is the issuer services, where we deal with the IPOs and all the subsequent transactions that happen in corporate India, and also on the mutual fund side, alternatives, pensions, private retirement schemes, what have you, and also the only entity who's also global in nature. We expect the rest of the year to be as resilient as the quarter that had gone by. With about 31% plus top line growth and nearly 60% around PAT numbers growth. Q1 is typically slightly quarter where we have less operating margins. That comes from the fact that 1st of April, the inflation costs associated with the labor tends to go up, even as the AUM tends to remain same or similar. In that context, we have shown remarkable growth, even in the EBITDA and the PAT numbers. Compared to Q1 of FY24, the way we are today is a near 400 basis points expansion in the margin. Having had such a good start to the quarter, we expect the rest of the quarters to be way better than where we are at this point.
All right, I take your point. So 30% plus kind of growth on your top line, would that be a reasonable ask for FY25?
We do not necessarily give guidance, but if you see our CAGR, we've been growing up north of 20% over the past 5 years. We expect this year to be better than that. Especially in the context that our non-mutual fund revenue is poised to grow much faster. If you see the quarter that had just gone by, year on year, the international and the other asset classes, the revenue has gone up nearly 60%. In the last 4 weeks alone, we have signed a bunch of new contracts whose revenue is expected to come through to the rest of the year and into the following year. So it is a reasonable assumption that we will be able to clock in the raw results.
And what would the revenue mix be like? So you, just for viewer context, you've spoken about mutual fund versus others. Just give us a breakup, if you may, on that revenue. 838 crore FY24 top line. Just if you can give us that.
Sure. Our mutual fund revenue is roughly about 65%, and the remaining 35% goes to the other businesses. Issuer services is around 15%. International has grown nearly to about 12.5 to 13%. The rest of it is value-added services, where we have expanded our offerings into the pure tech-driven solutions and services to our clients and our clients who are not necessarily in our mutual fund business and the registry business, so to speak. So that's the equation. So 65, the broader book, and the remaining 35% for the emerging businesses. It should be noted that we had pretty much zero of the rest of the business, with the exception of issuer services. About 5 years back, we have carved out a near 20% plus new revenue coming from the international and other asset classes, which we haven't been doing prior to the last 2 years.
Sure. And how would that mix continue to change, say 2 to 3 years from now? How do you foresee that?
Our goal had been risk diversification. We are extremely bullish on India, extremely bullish on India's capital markets, but financial services is of such nature that you will hit cyclicalities at some point in time. Our risk mitigation strategy, which we have adopted about 5 years back, was to broaden our horizons into every asset class, into broader business services, which included fund administration and not just RTA, and also a global expansion. With the intent that the reliance on the pure domestic mutual fund revenue be brought down to near about 50%, even as our overall book grows. So in the next 3 years, we are hoping to get somewhere near that. It will be a little tougher ask, especially in the context of Indian mutual funds growing so rapidly. But nearly every other business is growing twice as fast as the mutual funds for us. So we expect the mix of domestic mutual funds to be somewhere around 57 to 60% into the next 3 years, even as other businesses grow much faster.
All right. So quick contraction, maybe not contraction, but quick change in mix, if I can call it. I want to try and also talk to you about geographic expansion and how OPEX will evolve. You've guided for a 10% OPEX increase on a year-on-year basis going forward. And just talk to us about how geographies will evolve and what geographies will contribute to growth going forward.
Great question. If you see our current geographic profiling, we are largely an Asia-Pac player. Beyond India, we have clientele in Malaysia, Philippines, Hong Kong, Singapore, and Thailand, with a physical presence in Malaysia and Thailand, and soon to expand into other geographies as well. These particular markets, we typically tend to perform similar set of services as we do in India, which is probably mutual funds. But now a very fast expansion in the fund administration is what we are seeing over the past 2 quarters, more specifically. We expect this geography to continue to grow, as we had been, little around 60% year on year on a CAGR basis for the foreseeable future. We expect to start our European and American operations in time to come. Of course, we need to go through the regulatory processes. Scoping of the market has already been done, and so has the platform creation from our standpoint. So to that extent, hoping in the next couple of years, you would see us not just an Asian player, but a truly global player. In terms of OPEX expansion of 10%, that's pretty much about 7 to 8% on account of inflation in India, both in terms of tech cost, which is a pure cloud provisioning, as we have become the first fully enabled cloud market intermediary in our country, and of course the wage inflation. Even though a lot of productivity gains do come through, the expansion of these costs is there. And then about 200 to 300 basis points of our OPEX largely is because of our international expansion, where we create platforms which are fit for purpose for every single geography, keeping in mind the fact that the regulation is very, very different in every other part of the world. And the same is a case with the wage inflation. While the inflation may not be very high in some of the other geographies, but the base cost itself is slightly higher as compared to that of India. So we do expect that anywhere around 10%, averaging out into the next 3 to 4 years, and with revenues growing the way we are, we expect to see a tangible increase in our overall operating margin on the back of this.
Absolutely. So that's coming to my next question. So if 10% increase on the expenses side of things, that should leave you with significant bandwidth to increase EBITDA as well as margins, which are already very healthy. You're at 42 this year versus 38 last year, and you've guided for 40 to 45. Do you expect you can exceed that maybe FY26?
Every opportunity exists to increase our operating margin, but we are not an entity which is chasing as much as a higher margin, as much as higher growth. We believe in continual investments and reinvestments into our technology solutions, platforms, geographical expansion, and the business services. So if you see our expense, or at least the percentage of our tech spend to our revenue has steadily grown from about 9% in 2021 to near about 30% plus now. It just tells you in terms of our intent to not just be satisfied with about 15 to 20% growth, but to try and orchestrate a significantly higher growth profile, which requires investments. And some of those investments would ease into the operating margin, and which we are pretty okay with this at this moment.
All right. I want to also try and cover what are the new deal wins, what are the new geographies you're looking to target, what are the new clients that you're bringing on board, just to get perspective on diversity, plus get perspective on where the growth opportunities are.
Certainly. I do not see a single business vector where the growth opportunities do not exist. I think it's just a matter of where you have higher. For example, if you see our alternate investment fund profile in India, today we manage near about 37% of the total funds, up from just about 10 to 12% about a few years back. And we've been the fastest growing fund administrator for the alternatives in India for the past 24 months. So we expect to continue to grow in that sector even as we create fit for purpose solutions, and alternatives market in India is poised for significant growth In the last 3 years, the alternatives market had grown at a CAGR of 60%, and we have far exceeded the industry growth from that standpoint. We have, at the same time, on the international front, if you see, as the number has grown to near about 75 different contracts, it needs to be kept in mind that it was practically zero just about 5 years back. So all the new contracts we won between the end of the quarter and today as we speak, we have signed 2 sizable contracts in Malaysia. And that is something that we believe that will help propel our international business revenues into the coming quarters and years. Even as about 12 additional contracts we have signed will start to go live sequentially into the coming few quarters. We have been pretty focused on other avenues such as wealth management, which is not traditionally linked to the RTA as a business. And there too, we have had a series of contractual wins into the Q4 and even as we speak into this current quarter as well. From the standpoint of issuer services, which truly had been our oldest line of business, we have won the contracts of what would be the largest IPO in our country, Hyundai, to series of new IPO wins as and when they all go public. It would then add a significant number of folios and a total revenue count in the issuer services as well. Even our smallest line of business, the pensions, the industry had grown at about 12% in the quarter that had gone by. We have grown at about 27%. So even though the industry had been growing at a certain pace, we have been growing at a pace which is faster than the overall industry average, which some way will help us to start significantly expanding our market share into the coming months and years.
Got it. And my last question is on the cash balances you hold in your balance sheet. 250 crore at the end of FY24. Probably did a dividend distribution post that, but you still hold significant cash. What's the strategy here going forward?
Sure. As of the quarter ending, we are sitting on a cash surplus of about 450 crores. As we speak today, it should have crossed 500 odd. Our capital deployment strategy largely focuses on expansion of our business services or geographies through mergers and acquisitions. If you track into our company's profile, nearly every year we have acquired at least one company, if not more. We continue to look at opportunities as such. We haven't been a very high dividend paying entity. That's actually because we, as I said, we are looking at a significant addressable market with the overarching vision that we have, which is to make KFintech the first truly global fund administrator coming from India, which we do not have at this moment in time. That requires continual investments both into technology and the platforms, followed by the mergers and acquisitions. So we expect to continue to deploy our capital very, very purposefully in a margin accretive manner in these 2 lines, which is again tech transformation and mergers and acquisitions.
All right. And with regard to your investors, you have General Atlantic, which holds a 32% stake in your company. Any plans to divest or they're going to be longer term holders?
General Atlantic had been a very long-term partner for us, nearly about 7 years now, and it is for them to answer, but we do believe that they see this entity and this business to be a very, very fast-growing entity into the coming years as well. And I'm confident they will be around for a foreseeable future.
Understood. Thank you so much. It's been a pleasure chatting with you, Mr. Nadella. And of course, we'll chat with you more about the business itself, maybe somewhere midway through the quarter.